Hello, this is David Mandy, President of O&M Partners. I want to welcome everyone to the Regulus Resources Town Hall call. We've got two groups today, professional money managers that have joined the call, and also our retail audience that's listening in the background. Welcome both. Just for anybody that's new to these calls, O&M, as we like to say, really provides a public information edge to investors, particularly outside of the brokered universe. On Wall Street, we see the broad money cycles in and out of areas and certain industries, and mining is certainly in a position now where all the stocks have been sold off and ignored by Wall Street for some time now, and thus the valuations are very cheap. And today we're going to, this is an exercise in kind of understanding where we are for a copper company in the copper cycle, and then how best to play it. Today, to start off, we're going to talk about copper. We've got John Gross, John E. Gross and company he runs a metals management and consulting firm, which he established in 1987. To assist companies in procurement of metals, scrap, recycling, price risk management. So he really understands copper on the ground floor. In addition to his consulting activities, John has worked as a global leader in the metal industries for 45 years. He worked at U.S. Metal Refining, Hudson Bay Mining, Johnson, Matthey, and Wallace. He also worked with Scott Brass. John's also a highly decorated Vietnam veteran and a publisher of the Copper Journal, which is an industry newsletter. And he was also a director of the American Copper Council, and had served as a member of the COMEX Advisory Committee. So a really full professional life. And on that note, I'm going to turn the call over to you, John, and welcome you.
Very good, David. Thank you very much, and thank you for having me here to talk about the greatest metal known to mankind. I'm going to take a very broad brush approach in this presentation. We're going to begin taking a look at copper from the 30,000 foot level. So here we're looking at the price of copper from 1950 to 2018, and that is the annual average price. So the first thing that jumps off the page is over this nearly 70-year period, you can see that copper moves in cycles, has a tendency to trend upward. That green line is the 20-year moving average. And so you see where we are today relative to moving average. You see that period in the around the 2000 area, which was the worst bear market for copper since the Great Depression, insofar as the price fell below the 20-year moving average. And if you recall, at that time, we had the dot-com bubble bursting, followed by 9/11. So it was a very, very, very poor time for copper, but the market did recover, as it has a very, very strong track record of recovering. So where we are more recently is the market in 2016 fell close to that 20-year trend line, but then bounced off of it to where we were at the end of last year, or during last year, with an average close to $3 a pound. So if we look at this market from the long-term point of view, that 30,000 foot level, I ask you to think about something like if you're flying into New York at night and you're passing Manhattan, and you look down and you see all of the buildings with the lights on and your street lights going and all the bridges lit up and the trucks and the trains that are moving, the common denominator for all of that is copper. Copper conveys the power, the electricity for all of those lights and for everything that contributes to the standard of living that has increased over time. So if we take this down to, say, the 20,000 foot level, and we look at copper from 1970 to 2018, so we're looking at about a a 68, 69 year period of time. And here we're looking at it on a monthly average basis. That is the black line. The red line represents inventories of copper held in COMEX, London Metal Exchange, and Shanghai warehouses. So if we go back to the early 70 period and into the early 80s, you see that there's a fairly consistent inverse relationship between the price and the inventories. That is to say, as demand for copper picks up, inventories decline and the price rises. When that cycle is complete, the price begins to decline and inventories rise. And we see that cycle reoccurring. And here I would point out that we have experienced 6 very broad bull markets that have occurred over this period of time. The first one is that 73, 74 period, when the market rose to a record high $1.25 in that cycle. The second one occurred in the 79-80 period. And as a point of reference, both of those periods coincided with not only strong economic activity, but very severe inflationary activity in our economy as well, global economy, certainly. The next period back up. The next period of that, back up. The bull market in the 87, 88 period was a very, very strong move, very, very low inventories at the time, and lasted a very long period of time. But that cycle ended. The market came down, inventories rose, and we get into the mid-1990s, where we have another bull market occurring, but it was not fundamentally driven as were the 3 prior markets. That is to say, you may recall in that period there was a very significant speculative trading activity going on that had a very strong disruptive influence to the global copper market. That was a trading scandal that was tremendous in scope. And the market fell severely from that point into the 1998, 1999 period, and then recovered from there. And that base between 1999 and 2001 is what created what went on to become one of the most powerful bull markets we have ever seen, because the price moved from 75 cents to $3.75.
I know if they can see me.
In a fairly short period of time. But the other thing that I would point out in that move is in that 2002 period is when China surpassed the United States as the world's largest consumer of copper, as well as other industrial metals. And so we see the inventory levels falling from well over 1 million tons held in exchange warehouses down to less than 100,000 tons. So we get the impact of the market responding to that. And then we move into the 1998 period, the 2008 period, where we had the economic crisis occur and the price collapsing. The price fell from $3.75 to a pound to about $1.25, in fact, by the time we get to December. And then we enter that period where we have central banks throughout the world, in the United States, in Europe, in Asia, all pumping money into the financial system to prevent a collapse of the system. So we have this quantitative easing. And this is, certainly from where I sit, this is the anomaly that is still influencing the market today. And by that I mean, when the price began to recover in 2009, and went on to make a new record high in 2011, that was not driven necessarily by the fundamentals. That was driven by trillions of dollars being injected into the global financial system. And so from that high, we had the price over the following 5 years come back down to about $1.75. And from that point, that was January of 2016, we rose to a new high in June of this year, and then the market retreats again. So if we take a look at the next slide, and that focuses in now on a 20-year period from 1998 to 2018. And if we focus on where we are currently to the far right-hand side of the chart, the price has moved sideways at $2.75. But the anomaly here is that we have seen the price decline from January through the fourth quarter, and yet inventories have declined at the same time. So there's something wrong with this picture. It doesn't add up, okay? And part of what I believe is happening is that, for one thing, we have the trade issues that began to impact the global economy going back to June of this year. We also had the U.S. Federal Reserve beginning to reduce the quantitative infusion of cash to the system, beginning to withdraw it. So let's call that quantitative tightening. And so we have the price kind of moving sideways with inventories declining. And so as I was looking at that at mid-year, and I'm saying there's something wrong here, and I look back in time and I say to myself, you know, I've seen this picture before. This is not the first time we've seen this happen. So if you go to the next slide, and we're looking now at 1970 to April of 1987, and the same thing occurred. You can see that the inventories in 1983-84 period declined from 800,000, and the price was declining right along with it. Or at best, the price was beginning to move sideways. And this is a very, very interesting chart because while most people certainly view the market from a fundamental point of view or a technical point of view, but what occurred here incorporates another way of the market responding to events, and that is sentiment. And the sentiment at that time was very, very negative. And if you recall, if you go back to somewhere about the 1984 period, front cover story on Business Week was the death of mining in America. And that was a reflection of the bearish sentiment that prevailed in the market despite the fundamentals improving. So that can't continue indefinitely. As inventories continue coming down, what that is really telling us is that the market is in a deficit situation. All right. So if we take a look at the next slide, we see how the market responded. So that period from 1984 through 1986, if you just envision a spring being tightened up in a watch and tightened up and tightened up, finally it's going to explode, and that's exactly what happened. So we saw the price move from 60 cents a pound to close out the year at almost $1.30, more than doubling in less than a year, and inventories continuing to come down. So if I take that and superimpose it on, if you'd back up onto the last slide, please. The previous slide. Back one more. There you go. So, nope, go forward. There you go. So we have the market moving sideways for a number of years before it finally responds to the improving fundamentals. So the way I'm looking at the market right now, and in the very short term, I can argue it both ways, both higher and lower. I can argue it lower because the global news right now is negative. We've got China slowing down. We've got the Brexit situation getting worse. We've got people in the US talking about a recession here. So all of these things are weighing on copper, weighing on the price, I should say. Inventories continue declining. COMEX stocks of copper are now less than 100,000 tons. Total inventories of copper represent less than 1 week of consumption. That is inventories held in exchange warehouses. So the potential for the market to move sharply higher is certainly with us. And in a issue of the Copper Journal that I wrote back in June or so, I was doing my fundamental analysis at that time. I was doing my technical analysis at that time. And my conclusion was it will not be too long before we see copper at $5 a pound. And I stand by that. Right? So I get a call from somebody saying, $5 a pound, blah, blah, blah. It's not going to happen. I said, well, fine. Here's what I'm seeing. Here's why I'm saying what I'm saying. Interestingly, the week after I wrote that, there was an article in Barron's that said the price of copper had the potential of tripling in 10 years. You're talking $10 copper. So all of a sudden, $5 didn't look it didn't look as bullish anymore. So that's my message. And if I could just leave you with one last thought, that you might recall the movie Moonstruck, and Cher's father was Vincent Gardenia, who was running a plumbing business. And he said, if you want to do it right, you got to use copper. And there you have it.
Thank you, John. It was a great presentation. Really gives us context. Thank you again.